Hey, so welcome back to the next episode of What's Your One More. This is the second part of the conversation I carry on with my guest, Dan Habib, who was just dropping a tremendous amount of knowledge in that episode. And Dan's one of those guys, once he gets going, it's hard to stop because you don't want to stop him. He's got so much great stuff to give. So we put this into two parts. Here's the second episode of that interview between Dan Habib and myself.
The next question here is who is going to be the next Fed chair? And it's interesting the way that this has been unfolding. And it's hard to decipher through because, listen, we all know President Trump has an interesting style, and he likes to keep people off balance. And in the beginning, it sounded like he had four candidates, but two really good ones. He was like, you know what, we have four candidates, and he really didn't even mention Waller, but everybody assumed that Waller was one of them. We really didn't know who the fourth was. And then he said the two Kevins are doing really well. That's Kevin Warsh and Kevin Hassett. And I really thought Warsh was the front runner, and he may still be, but because, I mean, the guy is brilliant. He used to be a Fed governor for several years, and he mentioned the Kevins are doing well. And I just thought he was near the top with Hassett maybe, and also with Waller. But the administration now has said, we're expanding the search. And now the latest is that there's 11 candidates, and Treasury Secretary Scott Bessent is going to interview all 11 and then whittle it down, and then the president is going to choose. So that is going to take longer than previously expected, which I think reduces the likelihood of having like a shadow Fed.
Sure.
Okay? But I have here the list of the 11 people, as well as the Polymarket odds of them being the next Fed chair. And if you remember the election and stuff, right, they had Polymarket. Now, to be fair, this is something that they showed on CNBC, but I looked into it a bit. It's not like there's a ton of volume there, right? It's not like how it was with the election. So you have to take it with a grain of salt, but this is what some people are thinking. Fed Governor Chris Waller is the leading candidate according to this at 35%. And then you have Hassett, you have Warsh, and then you have former St. Louis Fed President James Bullard. And boy, I was surprised that they added him into the mix. I mean, listen, the guy had a lot of experience on the Fed, but when we used to talk about him when he was the actual St. Louis Fed president, you know, jokingly a bit, we would call him James Raging Bullard because the guy was a little bit out there as far as he loved the spotlight. You know, he would really kind of put some things out there sometimes that were way out there. But nonetheless, I mean, he had more FaceTime on the media than every other Fed member combined when he was there.
Yeah.
So I don't think personally he'd be a great candidate, but you can see they've expanded this search. I mean, you got former Fed Governor Larry Lindsey. You got somebody from BlackRock, which, boy, that would be interesting. Rick Rader from BlackRock. Lori Logan, the former Dallas Fed president, the current Fed Vice Chair Philip Jefferson. We already know about Bowman. And then you have the economic advisor to the Bush administration, Mark Summerlin. He's actually spoke on CNBC today. And of course, he said he was in favor of a 50 basis point cut in September. You know, it's hard to decipher through because clearly there's a lot of people now that are lobbying for the job. And if you want to lobby for the job, what are you going to do? You're going to appeal to what Trump wants, which is bigger cuts and more frequent cuts. But nonetheless, I think the Fed should be cutting. And the real reason why I think they should be cutting is the labor market showing weakness. Inflation on the consumer side has been tame, but even if it goes up, it's temporary, one-time price increases. The Fed is supposed to look through that. But the other thing is this. It'd be one thing if the Fed was neutral right now. And what I mean by that is this. So, Quinton, the Fed, they always say they want to get to neutral. So when you have a crisis happen, when you have COVID, the Fed cuts rates. Okay, and they get very accommodative. They cut rates to zero. They bought $100 billion a month in mortgage bonds and treasuries. Why do you want to be accommodative? Because you want to make lending as cheap as possible. Because when money's cheap, people borrow, the economy expands, and you want to make all interest rates lower. So people are paying less interest on cars, on credit cards, you name it. That clearly sparks the economy. Now, you want to be restrictive when you have inflation running too hot, like 2021, where they hiked rates to 5.5%. So 5.25%, 5.5%. So the Fed wants to get to neutral. So that means they want to get their Fed funds rate to a level where they're not being accommodative to the economy and they're not being restrictive. So now that we understand that, where are they now? They're restrictive. And some people's neutral rate can vary a bit. According to Waller and Bowman, the Fed's restricted by 1.25% to 1.5%. I think they're restricted by somewhere between 0.825, let's call it between 7/8 and 1%. But what does that mean? That means that they are currently slowing down growth and putting their foot on the neck of the economy by this much. So it'd be one thing if the Fed was at neutral. Well, you could argue, hey, you don't want to be accommodative because there's concerns about inflation and blah, blah, blah. But they're restrictive. So you could cut 3 times to 4 times and still be restrictive. Why wouldn't you want to do that to try with the long and variable lags of monetary policy to get ahead of the labor market, which looks like it's falling off a cliff a bit, and because you're so restrictive and because there's signs the economy is slowing? I mean, I think that that's logical in my opinion.
Oh, and this shows up in the job market. I mean, the restrictiveness is there.
Yeah. So we'll see what happens with the Fed. In my opinion, I think they're going to cut 25 basis points. Now, here's something that I want to bring up. Is it going to help mortgage rates? Now, people saw last year that mortgage rates actually moved a little bit higher after the Fed cut 1%. So September 18th, November 7th, December 18th, the Fed cut 50, 25, and 25 for a combined 1%. Now, most people do forget, in anticipation of the September meeting, we saw mortgage rates drop by about 0.75%. That did happen. You see this green line. But once the Fed cut, they stayed stable for a little bit. This was the 50 basis point cut, but then they moved higher. And then they cut 25 and they moved a little higher. Then they cut 25 and moved a little bit higher. So what gives here? If the Fed were to cut this time around, will we see mortgage rates actually respond well, or would it go the other way? It's important to know the Fed's not cutting mortgage rates. They're cutting the Fed funds rate. It's not a long-term rate. It's a short-term rate. It's actually an overnight rate that banks use to lend to one another. Has a direct impact on short-term rates, your money markets, short-term treasuries, credit cards, car loans. But it does still have an impact on longer-term rates. It's the way my father says it is like the mother's milk. It does impact everything. But here is why we didn't see it help mortgage rates. Although in anticipation, they came down 0.75%. The reason why is because we had the jobs market. The BLS came out in September after the cut, 254,000 job creations. November, cut 227,000. December, 256,000. We know now those numbers are baloney. That didn't help. And then also we had the 2 hottest inflation readings of the year, January and February, which those didn't help things. So I don't see this happening again, especially when you look at a long-term correlation. Now, look at this chart. There's no arguing that throughout history, the Fed funds rate, the blue line, 30-year mortgage rates, the green line, they trend pretty well together over time. Now, clearly you could see them break that trend on the last cut at the end of the year, the last few cuts. I think this time around it's going to help things. So I'd be rooting for that if you want to see mortgage rates come down. So, Quinton, I'll pause there for 1 second if you wanted to say something.
Yeah, no, I was thinking, I agree with you. I think that was that's the punisher in the market you were talking about, that BLS report. Punish. And, unfortunately, we discover later that the data is not, it's not dependable. But yet the market reacts, as you said. And that's super unfortunate because the dominoes are set up. And then all of a sudden you get this windfall. The Punisher comes in and just wipes the whole board out. And every time,
the Punisher.
Everything has been set up for this to work for us, right? Everything has been set up. And then there's the epic fail at the end. And that's just completely unfortunate. But I think that your point is very valid that, those are framing moments that aren't going to continue to happen, right? And as we move into mortgage rates here, and I know you're going to give your forecast, I say this about our audience, like Dan is throwing a ton of data at you. And he's got one hell of a presentation put here. All of this is going to be on our YouTube channel at What's Your One More with the number 1. That's at What's Your One More with the number 1. Check that out. Subscribe to that. But get in here and take a look at these graphs that he's putting together. There's a lot of time, energy, and effort here, and they're very, very good and easy to read. And I can't stress that enough. So if you're listening to this on Apple, go ahead and check it out on YouTube. Some high-level stuff on here that you just can't get anywhere on the internet when you go Google this stuff.
Well, thanks, Quinton. And let's talk a little bit about where mortgage rates are going to go.
Let's do it.
On my cover slide, I mentioned that the bull market in the mortgage industry is a lot closer than many people think. And the reason why is because there's a lot of things that can help rates come down. But not only that, rates don't have to come down as much as many people believe for it to really change our industry from an activity perspective. So remember, there's been a lot of loans done over the last several years at much, much higher rates. And do I think rates are going to come down a 4 handle in front of it again, or even a 5 handle? I don't. But if rates come down to the low 6s, heck, if rates get under 6.5%, I'm going to show you what the impact would be. So let's talk about some of the driving forces, right? We talked about the Fed cutting rates, which I believe they're going to begin to do. That will help. Talked about the labor market. We see weakness, continued weakness, which, boy, we're starting to finally see indicative numbers. That will help. If the inflation numbers after some one-time price increases remain tame, that will help. But Scott Bessent, the Treasury Secretary, I think he's a pretty smart guy. And my father, Barry, had a personal conversation with him. And this isn't like public knowledge, but what he told Barry is his target on the 10-year is 3.9%. Now, he has publicly said he wants to unfreeze the housing market. And that's good news, right? I mean, we want a Treasury Secretary that wants to see rates come down and wants to unfreeze the housing market. What can he do in order to do that? Does he have the power to institute some changes and some progress towards that goal? Well, one of the headwinds causing rates to remain elevated is the debt. And what I mean by that is our debt is like 37 trillion. We continue to deficit spend, which means we are spending more than we are taking in tax receipts. That's how a country earns its money. And when you do that, how do you come up with the money? We don't have like a literal printing press. We issue debt in the form of treasuries that we pay interest on, right? We have to pay back. And when you are issuing a ton of debt, a ton of treasuries, they have to be absorbed by the bond market. Now, you ever see all these auctions that they talk about? You have your 2-year treasury note auction. You have your 3-year, your 5-year, your 7-year, your 10-year, your 20-year, your 30-year auction. That's us coming up with money by issuing debt. It has to be absorbed by the bond market. Now, that's a headwind to rates coming down because if you flood it with supply, it's going to get absorbed eventually at some price. You go back to your macroeconomic days, some equilibrium price. But if there's a lot more supply, it'll probably be at a lower price. And if we're talking about bonds here, that's a higher yield. So that has hurt us. And just to give you an analogy, let's say you are looking at your housing market that you're living in right now. If all of a sudden there was 10,000 homes that came on the market, what would happen to price? Well, you'd have demand to probably absorb these homes at some price, but because of all the supply, it would push prices lower. And in our case, lower prices on bonds means higher yields. So this has hurt us. But what hurts us more is the longer term treasury issuance. If we're issuing all kinds of 10-year treasuries, 30-year treasuries, that hurts us more directly with mortgage rates. The short end of stuff, listen, it can still lock up like liquidity and stuff, right? Because people only have so many dollars. So if they're buying all short-term treasuries, then maybe they don't have as much liquidity to spend on longer term, but it has much less of an impact. So Scott Bessent is smart. He understands this. So he says, you know what? I want to issue more shorter term debt. Term the debt shorter. That would help things. It's actually the opposite of what Janet Yellen did. Janet Yellen made one of the dumbest moves where when rates were like ridiculously low, she saved a few basis points and issued short-term debt instead of issuing longer-term debt. She should have locked in that low rate.
Yep.
Then rates went up, and then, boy, we got crushed on having to pay so much more in interest. It actually makes sense now because it's believed that rates are going to come down. And if you term the debt shorter, it's not going to have as much of an impact on mortgage rates, things like the 10-year, and it can certainly help to unfreeze the housing market. But the big thing that Scott Bessent wants to do, and there was actually some talks about this. I was speaking with Barry about it today where they're making progress on this. They want to do bank deregulation. So what's that mean? Well, banks, they make money by taking our deposits in. So you deposit your money at a bank, they pay you a very small amount of interest, but then they take that money and then they lend it out at a higher rate and they make the spread. It's one of the main ways banks make money. But they can't lend all of it out, right? They have to have reserves and things like a supplementary leverage ratio. So right now, they don't have a big impetus to buy treasuries because if they were to do so, it would go against their capital ratios and they wouldn't be able to lend out as much. But the bank deregulation deal says this: treasuries are a risk-free asset backed by the full faith and credit of the government. And whether you agree with this whole deal or not, if this deal gets passed, which it looks like it's going to, it would open the door for the largest banks to buy treasuries, because then they'd be able to buy treasuries, absorb a lot of the supply. You'd have a new source of demand for all of our debt, and it wouldn't count against their supplementary leverage ratio. And there's like 3.7 trillion in reserves. So there's a lot of money that can then be deployed to absorb treasury. So that could really help rates come down in the coming months.
Today's episode is brought to you by Texana Bank Mortgage. They're coming to the table with a revolutionary product. It's called REMLO, Real Estate Mortgage Loan Originator. And what they are doing is they are taking real estate agents and they're taking loan officers, and for the first time in history, they're putting them together under one umbrella. They're actually taking two industries right now that sit on top of each other, and they're putting them together and backing it by a full-service bank licensed in all 50 states. So imagine this: you're not just an agent anymore, you're a full-service agent. You're the single trusted point of contact for your client in this entire process. You're seeing the loan and the home search front to end. It's going to change the dynamic of real estate and mortgage lending together. Now, if you're a real estate agent, I want you to do me a favor. I want you to go to askaboutremlo.com. That's askaboutremlo.com. Because what you're going to find there are significant details about this program, how to enroll, and how to gather more information. So if you're ready to adapt and thrive, go to askaboutremlo.com. That's askaboutremlo.com.
Quinton and I talked about this before. I know crypto is probably like the hottest thing now. I mean, Bitcoin just set a new all-time high. At the time of like recording yesterday at 124,500 or so, Ethereum's been taken off. And I think crypto can help mortgage rates to come down. And we're going to do a longer show, to get back to that point, on cryptocurrencies, answer a lot of...
This is like a whole nother episode, but in summation, I love where you're going with this.
But I think crypto can help mortgage rates come down, Quinn. And people are like, well, how the heck's Bitcoin, Ethereum? How's that going to help mortgage rates come down? They're not, but there's a lot more than just those riskier assets that you're thinking about. There's something called stable coins. And stable coins are like the hottest game in town. Everybody's trying to create one. Why? Because the future is in the blockchain. And everybody's trying to create stable coins because what they do is it's a cryptocurrency that essentially mimics the dollar. It's pegged to the dollar, and it gives you a crypto version of the dollar that you can utilize in blockchains. And there's so many advantages. Imagine making payments cross borders, or, even like selling things and having settlement plus one. It takes time. It's expensive. It's not efficient. If you have stable coins running on blockchains, it eliminates all of that. It's faster. It's cheaper. It has finality. It has instantaneous settlement. And it bridges the gap between traditional finance and the dollar and cryptocurrencies and the blockchain. So everybody is trying to create stable coins. So how do you have a stable coin that is stable and they peg it to the dollar, and it's like a crypto version of the dollar? Guess what 80% of what stable coins own is? U.S. Treasuries. Now, right now, it's a relatively small market cap. Stable coins, it's about $240 billion. And 80% owned in treasuries on $240 billion, that's like $192 billion. But conservatively, the estimates are for this to go to $2 to $3 trillion over the next year or two, especially with all the deregulation now. We had the Genius Act. I mean, all these different things, okay? Clarity Act. So we are going to see this go to $2 to $3 trillion over the next year or two. And that means they're going to have to own $2 trillion or so in treasuries at least. So between bank deregulation and between stable coins, it's going to have a big source of demand for our treasuries. And by the way, why is it important that Bessett wants to term the debt shorter? Well, stable coins, if it's mimicking the dollar, it's got to be liquid. They're not buying 10-year treasuries here, so it can't absorb that supply. However, it's going to be short-term treasuries. And if we term the debt shorter, this can absorb a lot of that supply. So where's mortgage rates going? Well, mortgage rates always have a relative relationship to the 10-year. We know Bessett's target on the 10-year is 390. I think that's actually pretty realistic. But historically, 30-year mortgage rates are about 1.6 to 2% above the 10-year. Okay, so that means if you have the 10-year at 3, 30-year mortgage rates, they're 4.6 to 5%. Okay, there's a normal spread. But then there's periods of time, COVID, quantitative easing, hiking spree, where this spread can widen or narrow. And if you remember back here, boy, this is where you had 5-year, 10-year Treasury, 5% 10-year Treasury, and over 8% 30-year fixed mortgage rates. But the spread has been narrowing. And part of the reason why this happens, without getting too deep, is servicing values and prepayment risk here. And as rates come down, there's less and less and less, and servicing premiums re-enter. But the bottom line is this: the spread has been narrowing. It was 3.1 to 60. Now it's at 2.36. I think this will continue to narrow on a relative basis. We've actually been seeing mortgage-backed securities perform a bit better than the 10-year of late. So how low can mortgage rates go? Well, if we hit Bessett's target of 390, which, as I said, I think is realistic, and the spread goes from 236 to 2.25, where does that put 30-year mortgage rates? 6 1/8. Now, 6 1/8, I mean, maybe it's not what some people are hoping for, but that would change our business team. Okay, first of all, from a refi standpoint, if you get under 6.5, these are the numbers from ICE, which, it used to be Black Knight, but from ICE, under 6.5%, you have 4 million loans that are in the money for a refi. And they have like a pretty strict criteria. You have to save 0.75% of rate. You have to maintain, 20% equity in the home. But for perspective, all of 2024, there was 1.3 million refis. So you'd get 4 million refis if we get under 6.5%. And if we get to the low sixes, it's going to cause all kinds of purchase activity as well. And one thing I just want to talk about, Quinn, we saw after the jobs data, we saw rates come down a bit. And, we got mortgage application data this week, and it captured finally that decline from last week in mortgage rates, because the prior week was on a Friday, wasn't in the previous data. So last week, rates came down, according to the MBA, to like 6 5/8 or so. And you saw refis pop 23%. Great. But purchases only went up 1%. Now, people looked at that and they said, see, if rates come down, it's not going to help the purchase market. I think those people just don't understand what's happening here. With a refi, it's different. You either have a strike rate with your relationship or rates come down. People buy this data. You're getting solicited. Either way, you're getting called for a refi. Hey, do you want to refinance or not? Here's what you could save. It's like a binary decision. With a purchase, it's different. If rates come down, then you hear rates came down and you start the shopping process. It takes longer. It's not like all of a sudden the next week you're going to see a huge pop in mortgage applications to purchase. They got to search for a home. They got to find a home. They got to fill out an app. And then guess what? Rates all that time have to remain lower in most cases for it to make sense for them. So lower rates will help purchase activity, but it just takes a little bit longer. And let's talk about real estate, Quinton, because I've been seeing some garbage out there that has gone viral. And, we've been pretty accurate on the housing market, right? And I think part of the reason is our methodology, where last year we won a 4th Crystal Ball Award for the most accurate real estate forecast in the U.S.
Yeah,
we were
man,
kind
congrats.
of out on an island there. Everybody was saying home prices were coming down. We said somewhere around 4.5% to 5% appreciation. We saw 4.7%. I'd say that's a bullseye. Well, if you look at supply and demand, that has certainly helped. I mean, in most markets, like we were just talking about with cryptocurrencies or with housing, it's supply and demand. And demand, well, formations have been like 1.8 million on average for the last 5 years. It's a volatile number, but 1.8 million a year for the last 5 years. Now, we've recently seen that drop here. And I don't think that is a negative thing. I think what it's really showing you is how much pent-up demand we have on the sidelines. And once rates come down, boy, you're going to see an explosion in activity, especially if we get to the low sixes. And on the supply side, supply on forward-looking numbers, you have permits, starts, and then you have completions, which are being completed now on the new construction front. They've all been dropping significantly, but starts are around 1.3 million. So compared to the formations we've been seeing, certainly not keeping up. But then when you look at inventory, what most people focus on, and we look at active listings, you focus on all these articles in the news that they see where it's like, well, inventory is up 25%. And this is nationwide, right? So yes, it is up 25%. 30% of it's in like Florida and Texas. And real estate markets are different, right? So,
Right.
you have in the Northeast a much different scenario, but you just have to put things in perspective because 25% from last year sounds like a lot, but on a relative basis, if you look at pre-COVID nationwide numbers now, we're down 11% still. So we're still below pre-pandemic levels, and it's not like inventory was going wild there. And we have 12 million more people. But as I mentioned, inventory and home price appreciation, even, you have to look at different markets. Now, we don't know who we're talking to on this call here. I go over nationwide numbers, but in markets that you have a lot more inventory than pre-COVID, like Texas, like Florida, like Washington, D.C., like there's certain ones out there. There's a couple states. You probably see either small price declines or slower paces of appreciation, and you have a lot more inventory. But if you go to like the Northeast, it's like 40 to 50% or so less inventory than pre-COVID still. So it is a bit of a different market depending on where you look. But the bottom line is we're still not seeing like an insane, for the most of the country, increase in inventory. It's still tighter than it was pre-COVID in most areas. And we're not seeing home values decline nationwide or even significantly. We're seeing a slower pace of appreciation, which is different than seeing price declines or significant price declines. In most cases, you're still seeing slower price appreciation, meaning home values going up. But there's some articles out there that have caught a lot of attention that are scaring the crap out of consumers. And Redfin is guilty of this, where I see this thing everywhere. It was picked up by the Wall Street Journal, and they said there's 500,000 more sellers than buyers in the market. And boy, I mean, if these numbers were much larger in size, then it wouldn't be as significant. But we're talking about 1.943 million sellers versus 1.453 million buyers. So that's a huge difference there, relatively speaking, to the size of this. 500,000 more sellers than buyers. You would think we would see home values fall off a cliff. Okay.
Right.
However, most people, what do? They look at this and they go, wow, that's bad. And they stop there. You need to go deeper. Okay. So first of all, how did they come up with this number for the amount of sellers? Well, I just showed you active listings. You know what the number is? 1.1 million. So, I mean, I don't know where they're getting 1.9 million. Even if you add the new construction stuff, which, by the way, even if you add the absolute number, you don't get close to this. But you also have to remember on the new construction front that the vast majority are either not started or under under construction. It's like 100 and something thousand new construction units that you could actually move into. Okay, so
right.
Either way, you add the highest possible number that you don't get here. So I don't know where they're getting this. But what was really egregious was how they stated this with the number of buyers. So, Quinn, I'm going to ask you, how do you figure out how many buyers are on the market?
Well, I mean, it's a pretty tough number to come up with. I don't know if there's a data source I can go to that says, oh, there's so many buyers on the market. I mean, if I did it, I'm guessing is going to be the best way.
Well, the answer is there is no metric. There's
right.
no way to know at any given time how many people are in the market to buy a home. There's just no way to do it, right? However, they know this, Redfin. And they said it if you look at their methodology. Because there's not a metric measuring how many buyers are in the market, we developed one. We took active listings and pending sales from the MLS. We estimated what fraction of homes on the market will sell within a month. Analogously, we estimated what fraction of buyers on the market will find a home within a given month. How do you know how many buyers are on the market that will find a home in a given month? I don't know. And then they took, from the typical time from first tour to purchase, we took the ratio and then we applied this to approximate the ratio of buyers to sellers. So then they took this stupid ratio and they applied it to the amount of sellers, which is elevated. The answer is it's BS. And they were successful because it got all kinds of attention, was picked up by the Wall Street Journal, was on CNBC. I've seen so many people post it saying, this is terrible, this is bad. But the truth is, it's baloney. Now, don't get me wrong. I'm not sitting here saying the housing market's on fire. We've seen less activity. We've seen more inventory. We have seen much slower pace of appreciation. But there's not 500,000 more sellers than buyers, team. If there was,
Correct.
We would see significant declines in home values. And guess what? Little inside info. We won the 4th Crystal Ball Award from a Fannie Mae, Zillow, and Pulsonomics home price expectations survey that we partake in. It's the top 150 economists in the U.S. We are honored and blessed to be a part of it, and we've done very well. Well, guess what? Chen Zhao, she's the person that's like the head analyst there at Redfin that put this stuff together. I think she doesn't believe the numbers. How do I know that? Because I could see her responses. And for this year, she thinks home values are only going to decline 1%. If she thought there was 500,000 more sellers than buyers in the market right now, I think she'd think it was going to fall more. And guess what? In 2026, 2027, 2028, and 2029, she has home values going up. So there's no way she buys that baloney. I really do think this was clickbait. But you have to go deeper. And you have to educate your customers on this stuff because this is the crap that they're seeing. I believe it's hard to bet against the champ. Housing market up 77 over the last 83 years. And almost all the down years were the housing bubble. Very different scenario today. Home values do well during recessions. But here's what I think. I think we're going to see 3% appreciation over the next 12 months. Doesn't sound crazy. It doesn't sound that sexy, but it's meaningful. It means that if you bought a $500,000 home, you gain $15,000 in appreciation alone over the next 12 months. And this is the kind of messaging you have to get out to your customers and sift through and negate a lot of this clickbait that's just trying to strike fear in your customers' eyes and get attention. So, Quinton, we fire through a lot of stuff there.
Do rapid fire. I'm going to go back to that Redfin thing. I guarantee you at the end of that clickbait, there's a why you should apply for a mortgage now link in there. It probably goes right back to a company that may have acquired Redfin just to get some action going there. I can guarantee that happened somewhere in that article just to say why it's a buyer's market. You should go ahead and apply now just to find out when you get out to the market. It might be a opportunity, but it's not a buyer's market. You have sellers that are cooperating, but you're not going out there underbidding homes at 20, 30,000 and stealing them like that report would suggest.
I mean, it's definitely more of a buyer's market than it was for sure.
Sure.
And I think there's more inventory. You have less pricing pressure. You have, more options and such, obviously. And I think you have a bit more negotiating power. I don't think that you're stealing homes like that, but on a relative basis, I think it's a good time to be a buyer. That would be the message I'd be getting out to my customers. Listen, 100%. You might be waiting for rates to come down. When rates come down, it's going to be a more competitive market. There's going to be less choices. There's going to be more competition, and there's going to be more upward pricing pressure. Yes, rates are higher now than you would like. But if you get in when rates are higher, you get those advantages. And then you also capture the appreciation versus if you were waiting. And then when rates come down, the wonderful mortgage profession you're working with is going to refi you into that lower rate. And the amount that you would make on the appreciation and potentially the negotiation from having a bit of a buyer's market now compared to what's going to happen when rates come down is going to dwarf the interest savings if you were to wait for rates to come down by, let's say, 1%. That would be the message I'd be getting.
Yeah. And don't forget, 40% of all mortgages in the United States are free and clear right now. So these sellers, they've got all the power. They're sitting on things. They don't have to, even if they're listing it, they don't have to sell it right now. So I think that's another missed, that doesn't show up in that wonderful report Redfin put together. They left that part out too. So you've got a lot of sellers that are just sitting back throwing a number like, if I was going to sell my house, let's see what I can get for it. It doesn't matter. It doesn't mean I'm going to sell it. And, I don't know. I hate headlines when they're not done appropriately. So it just drives me nuts.
Quinn, it was such a pleasure being with you, brother. I have to jump.
Yep. You got it, man. Hey, thanks for being on the show as always, guys. Dan will be back for another round here. Guys, if you like what you're hearing,
yeah, bro, I'm looking forward to the next one. We're going to talk about something near and dear to my heart. Crypto.
Looking forward to it, man. We'll touch on the crypto a little bit more. Hey, thanks for being on the show again. Guys, if you like what you're hearing, please share this podcast. Check us out on Apple, Spotify, and YouTube at What's Your One More for all the charts. Thanks again, Dan, for being on the show.
Thanks,
We'll see you, buddy. Yep. All right, buddy. Bye.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it.